Welcome to the live stream. It is June 12th, 2024. The market has opened and it opened up substantially higher. And the reason for it is the inflation report came in and it came in at a favorable rate. Inflation is going down if you measure it year over year and also month over month. I'm going to get into that inflation report. I'm also going to get into the stock market with the trends that I'm seeing and review some stocks that I think are interesting now that we're seeing inflation go down. Before I jump into looking at the stock market, the inflation report, and individual stocks, let me remind you, I'm an individual investor. I offer no financial advice. I'm just reviewing stocks and sharing my opinion, my analysis on those stocks. I do not recommend you buy or sell any of the stocks that I am covering. Please weigh your decisions very carefully. Additionally, I am being sponsored by Moomoo, which is a brokerage, and they are offering a really nice offer for new account holders that open up an account with $1,000. The offer includes paying 8.1% on cash for the first 3 months, and then after that, 5.1%. That's pretty strong. Additionally, they'll provide 15 free stocks. And those stocks can range from value from $2 to $2,000. I'm waiting for my 15 stocks to be issued, and I look forward to seeing what stocks are in that basket of free stocks. Now let's take a look at the stock market and see what's going on. So the S&P is up 1.12% today, and it's after the inflation report was announced. Overall, the S&P is just having a great year again. We had a great year in 2023, and we just are keeping it going. We're looking at 14.59% year-to-date returns on the S&P, which is excellent. It's great to see stocks go up in value. I like to measure when, really the whole run started, and it really started in late 2022. And to this point, I guess measuring it, we're about 18, 19 months into this rally. We're up 51.57%, which is great. It's great to see stocks go up. It's great to see stock values increase. Overall, the S&P doing great. I do think the market is expensive. I continue to share that. When the market will go down or continue to go up is anybody's guess. I could just point to the PE ratios are high, stock values are high. And what I'm seeing is there's a kind of a imbalance where the mega caps have really gone up, NVIDIA being the poster child for how fast they've gone up. And then meanwhile, small stocks represented in the Russell have not gone up at the same rate. And some sectors like healthcare have not gone up, or energy have not gone up. So let's take a look at those really quick and see what they're doing. So when we look at the Russell, year to date, the Russell 2000, these are the small mid-cap stocks, it's only up 3.4%. The S&P is up, almost 15%. So that's my point is mega caps have really rallied, small mid caps haven't. Now, there is a discount on small mid caps, and it makes sense because some of these smaller companies are not easily recognizable by investors. Everybody knows who Apple is. Everybody knows who Microsoft is. But as we get into some smaller names, they're just not recognized by investors. So the comfort level isn't there. So that explains part of the reason why these stocks have been left behind a bit. But there is such a gap that I think there's an opportunity. There's an opportunity within the Russell 2000 to pick out some good quality mid cap, small cap stocks and hold them. There's another benefit to smaller companies, which is these smaller companies tend to be acquired. If they're really good, they get acquired, and then they pay stockholders a really nice premium. That happened to me with Activision. I was paid a really nice premium on Activision. I've been paid really nice premiums on the companies that I held that were acquired. The amount of acquisitions and mergers and so forth, it hasn't really been high. And if you noticed yesterday, the Paramount acquisition, didn't happen. It broke apart yesterday. So there's a company that didn't happen. Looks like Mike Victory is showing up. Thanks for showing up, Mike. I like the start of the day after the last several days of trading. Yeah, the start of the day. I mean, who could dislike stocks being up? The Dow's up 0.7%, S&P is up 1.14%, NASDAQ 1.63%, and then the Russell is up 2.83% in one day. So the small mid-cap stocks are really rallying. Why do those rally so much on a day like this? Well, when inflation goes down, and I'll kind of show that real briefly, the core inflation is looking to be going on the right trend, which is going down. And as it goes down, the Federal Reserve can ease up on interest rates. They don't have to increase for sure. Now the question is going to be, when are they going to start cutting interest rates? And that will loosen up capital for these smaller companies to use to grow. Smaller companies tend to be more rate sensitive because that's just the fact. So the inflation report coming in both on the month over month, it came in better than expected. And the core year over year came in better than expected. And inflation month over month did not rise. It just stayed even, although there was an expected small rise. So, I mean, the report was really good. It was reasonably better, which is good. If it would have been drastically better or drastically worse, you would have seen a lot of confusion. But I think everybody agrees inflation, this is a good report. The Federal Reserve chairman will have a speech later. They're going to announce later today, and these are all Pacific Standard Time hours that you're seeing. They'll make a decision. It's expected that they're going to hold interest rates where they're at. Now, they may comment as to when they're going to start changing rates, which could have an impact on stock prices. If they are persistent that, hey, inflation's a big giant problem, and the term hawkish, if they continue to be hawkish and say, we're still in a battle with inflation and we're going to have to raise interest rates, stocks will go down. I'm not expecting that to happen. It would be a super surprise if that happened. What I'm expecting is that the chairman's probably going to say, hey, we're going to wait for more data and then we're going to act. But we continue to see progress on inflation. And I think that will be enough for stocks to just, keep the gains that they have today and kind of set the table for what I think is going to be an expectation that rates will begin to drop over the next couple of years. So that news came out. I think it's positive news and overall well received by the market. The Russell 2000 is the big rally index. A lot of those stocks went up, so we'll see what happens there. Catch up on a comment. I'm doing exactly what you said, looking for undervalued stocks. Yeah, I like my mid caps. I'll go over a couple today. I think I've got a string of some pretty good mid caps that have done great. I think they've got more to go, and we'll get into those. If anybody has a stock you want to talk about, please put it in the comments. We'll talk about that stock. So those are my opening comments on the market. I continue to think that, it is a lot of fun to see the indexes go up, but we have to be reasonable, right? Like if we look at the S&P, it has corrections. Corrections are normal. And especially if you see this chart, right, this aggressive growth here, you can explain reasoning behind this, right? The Federal Reserve did put a lot of money into circulation due to COVID. And what that did is it just rose, asset values. Home prices are really high. Everything just went up and stocks really went up. Okay. Now, with this really steep rise, we saw a steep rise coming out of COVID, and then we had a pretty good correction in 2022 on the S&P. I think that it corrected like 25%, 26%. And we'll see how much further we're going to go up this rise, but there will be a correction. There's no doubt about it. I can't tell you if it's going to happen this week, next month, next quarter. I'd be very surprised if we didn't have a correction in 2024. If anything, just one that's 10% or more. I'd be very surprised if we got through the year without it. I wouldn't be shocked, but I would be surprised. I'd be shocked if we didn't have a correction in the next 12 months. Now, again, I'm not a fortune teller, but I'm just saying if you study history, history tends to rhyme. It tends to show you patterns. People will take profits. They'll say, hey, I'm doing great on this holding and I'm going to create some more cash. The great Warren Buffett is holding $180 billion of cash. And I think he's holding it because it's an expensive market and other investors are accumulating cash. Yours truly, I'm accumulating cash. I'm at 10% of my stock and bond portfolio in cash. I haven't been in that position in a little while, and I'm going to be ready for the next, opportunity, whatever that may look like. All right. So that's where the market's at. It's a fun morning to get started with some good gains. Let's go over the first mid-cap stock that I wanted to highlight, Ally Financial. For those that aren't familiar with Ally Financial, predominantly they do car financing, and they finance, all the different brands here in the United States. They've ventured into, they have an online bank and they have insurance services. They have other products as well, but their core business, the biggest part of the company, is car financing. And they're rallying 4.3%. Year to date, they've been going up nicely, 16%. They pay a nice dividend. It's about 3% right now. And really, the dividend rate was much higher when they were trading down here. I was buying up shares back here, and the stocks really rose nicely. And I like this stock because as interest rates go down, Ally gets more profitable. You think about, they're making car loans right now that are 8 to 12% interest rate. And when interest rates begin to fall and Ally's access to capital becomes less expensive, just more profit. And the company's been doing nicely. They had a down year in 23, but I think the quarterly also shows negative growth. But their stocks rallied because of the expectation that the car business is going to be better this year. We had supply chain constraints in prior years, and it's really loosening up. And I think Ally's going to have more volumes to do loans on cars and also do insurance, which insurance is for cars is really doing well. I also own Allstate, and Allstate's doing great. So Ally is a nice little stock. It's a $12 billion market cap. So it's not a giant market cap. Has a lot of room to grow. Analysts think it's fairly priced. It's priced, with a 2.79% premium. Their forecast on the stock, some people believe are very bullish with the stock, probably similar to where I'm at. And average is that the shares are worth about $39.24. And overall, it's a slight buy by analysts, and their forecast for earnings per share is really favorable. It's $3.06, and then look at the growth rate that it's expected. They're expecting a really boom in 25, and they're expecting a good year in 24. So good stuff on the horizon for Ally. I have the stock as a discount on this stock. I think it's 21% discounted, and I'm sitting on a 45% gain on the stock. So it's just been a good winner, and I think it has more room to go with the expectation that lower interest rates. I think this one's going to continue to do well. So, Mike Victory, what's your opinion on the movement of MPW? It dropped a good bit and now is starting to rise a little. I know ex-dividend date happened. Yeah, let's get into MPW. I do have comments on that. So MPW is a real estate investment trust, and they invest in hospital properties, healthcare, services, properties. And I like that because it's stable. We always need hospitals and clinics and stuff like that. And they got themselves into trouble with a bad tenant. Their biggest tenant ended up having financial trouble. But overall, if we look at the year to date, it's up slightly 2%, but that doesn't tell the full story. I think to tell the full story of where the stock is going and where it's been, you got to really look at the low point, which is January 19th to this point. It's up 63%. So it's been a really good mover in 2024. And you look at this trend, right? It's really upward. Now, this is a high risk stock and it continues to get less risky. And it continues to get less risky because the bad news, it's kind of digesting all the bad news. We've known of the bad tenant for a while now. And that bad tenant they've been dealing with. So first, they refinanced some of the debt and they successfully did that. The actual tenant Stewart sold a piece of their company to what is United Healthcare, which that automatically creates a better profile for MPW because the new tenant that's acquiring that business is United Healthcare. You can't get any better quality than that. So the bad news that has come out is kind of being processed. It's being digested. And the rest of the business is doing okay. Lower interest rates are going to help medical properties trust because REITs really depend on interest rates because they have to take on debt to buy these real estate assets. So I think in general, MPW, I'm buying more shares, and I don't make any recommendations. I don't provide any financial advice, but I'm buying more shares. And the reason for it is that they have a nice dividend. They pay a almost 12% dividend. And really, when I look at the company, I see that this company is going to make it. I think this company is going to make it through. And if they make it through, I just want them to get somewhere back to where they used to trade as a stock. They used to trade up around $10 a share not too long ago. And not sure why this chart isn't giving me the right data. Let me give it an update. Give it a nudge. Come on, Google. I reckon they have pretty good servers behind this. All right. So it used to trade around $20 a share. Okay. Well, just get back to half of that. I'd be a happy camper. I'll more than double my money. Half of that would be $10 a share, and it would give me 100 plus return. That's what I'm looking at. So as the company gets less risky, this proposition to me as an investor continues to get better. I'm like, man, looks really good. So if we look at the 5-day on MPW, it's down. You're absolutely correct. It's been down. Today's trading, it's up 1.5, which is good, but all stocks are up today, it seems, because it's such a rally. Again, I look at this trend here, investors have paid attention. The other thing too about this stock is that we have a lot of short sellers in the stock. We have 34% of shares are shorted. Well, there's a lot of pieces of new news that are helping MPW. And I got to think that these short sellers are getting nervous. They're like, hey, I got to get out of this position because this stock can really fly up to $10 a share and then they're going to lose money. So just a lot of things there with MPW. Risk reward to me looks good to me. So I'm going to keep buying MPW. And those are some comments there, Mike. Hopefully you found that interesting. All right. So looks like I've got a comment from Sam Faulia. Thanks for checking in, man. Could you look at LON.BMY, Bloomsbury Publishing? I'm interested in it at the moment. Okay. So I'm not sure if I'm going to have access to it. Let's see. No, I don't think. Oh, no, I do. I do have it. Man. Okay. So this is a publishing company. It's out of London. So publishing, I'm going to have some opening comments is, if we're talking about, because publishing is part of media, right? If we're talking about old school media, television station, we used to publish magazines and newspapers business. I'm typically not interested. It's just because it's been so disrupted that there's not a lot of money for those companies to make anymore, thanks to Alphabet, Meta, and everyone else who's online. Now we're going to have AI, and it's going to improve, change, increase, the type of information we get. Having said that, these guys do publishing academic, educational, and general fiction, nonfiction books for children, teachers, students, researchers, professionals worldwide. The company, okay, all right. So they're a publisher. They publish books. Kids still need books, and then schools, right? Like my I have two sons, and they're both in universities. One's studying a PhD, and the other one's studying his undergraduate. The undergraduate kid, they're giving him all the books digital. Part of his tuition is all the books in his classes. Gets digital access, so they're not publishing anymore. Back in my day, of course, we had to go buy the books. So their revenue, really nice growth. Small company. Is this British? This is in the British currency, and it's been really nice grower. Wow, I am surprised. And the quarter looks awesome. Wow. So they're growing. I think part of it is that they're really small. So growing might be, very easy or practical, I should say. So that looks really interesting. So they've been growing. What's their stock been doing? Their stock's up 35%. Very good. Analysts think it's 25% discounted. We looked at their revenue growth. If we look at their free cash flow, they have free cash flow of 33 million, I think, pounds. And at that rate, I would put this stock, I would say that it's worth, I don't know, 400 million to me. Yeah, it's to me, it's fairly priced at best, or it's being priced at a premium. And the reason for it is, I opened up with comments that I just don't like this business. There's thousands of companies I have to choose from. Would I rather put more dollars into Meta, which has a grasp on the future, or do I want to put money into Bloomsbury, which has a grasp on the past, right? Books are great. For their paradigm, they did a lot of service to mankind, but we're in a digital format. You guys are watching me over the internet. This was not possible, 20 years ago, where just a guy who's an investor in United States can broadcast, a live stream. And same thing with books is, I rarely buy books anymore. And the reason for it is that I guess my mind has changed and my preferences have changed to want things digitally. I don't want to read a 500-page book. I want a summary, and I want to read, maybe a couple page summary, or I want to watch a video on it. So those would be my comments on this company. I am impressed with their performance. It's pretty darn impressive what they're doing. It looks like they're a very well-run business, but I think this will always be susceptible to the digital threat. How are they going to be replaced in the future? Thanks for the question, Sam, and hope you found my comments interesting. And I appreciate you asking about that company. So it looks like, Mike, so you're buying more MPW. You have 4,000 shares. Very good to know. Let's see how it performs. Thoughts on GM? Yeah, we've looked at GM. Let's take a look at it again. And General Motors, man, and the car companies are really interesting. So it's up 1.6%. It is pays a dividend of 1% roughly. Look at this forward PE, 5%. A forward PE of 5%. That's so ridiculous. Analysts think it's discounted by 10%. I think it's done well, 32% over the last year. Year to date, it's up 37%. Go GM. I think their GM has really, I think they have very good leadership. I think their CEO is excellent. She's doing the right things. I think she's gotten rid of some models that maybe were not going to create a lot of value for GM. And she is kind of really made a huge investment into EVs. So all the right things are happening at the top. And if you look at their revenue, she's making a difference. The revenue looks good. They grew 10% in 23, 23% in 22. That's great growth. This is a massive company. They're a $171 billion company. Their growth, like I showed Ali, that's a tiny company compared to this. When you grow 9.6% on this type of revenue, that's deserves an applause. That's phenomenal growth. So I love the growth of GM. Their cash flow is good. They produced $9.3 billion of free cash flow in 2023. So I would venture and say this stock's probably worth $130 billion to me from a market cap, and they're only trading at 55 billion. And it's because their PE ratio, investors are believing that Tesla, NEO, these new generation companies are going to, take this business away. And I would agree that, those companies are exciting, but hey, here's the evidence that contradicts that whole story. GM's growing, and GM has a lineup of cars that are hitting the market that look pretty impressive to me. So I'm positive on General Motors. I'm a Ford stockholder, and I continue to buy Ford. I like their proposition. But this one here, man, looks solid. Every time I look at GM, I'm like, good job. Good job, CEO. Good job, company. This is one of the brands in the United States. They've been around for over 100 years. They've been an important part of American history as well as the American economy. So I'm always rooting for this company to do well. I think when they do well, a lot of employees have jobs. So I like seeing GM do well. Yep. And Sam, thanks again for asking about that really interesting company. Thank you for tuning in and asking. BMY and Pfizer, which do you like most? All right. BMY is Bristol Myers. All right. So Bristol Myers is down today. That's interesting. I guess with lower interest rates, we're going to need less pain medicine for our headaches. And that's a bad joke. All right. So some things about Bristol Myers. So revenue has been having a downward trend. And the thing about like pharma, right? Eli Lilly is the star of the show within pharma. Those guys, I tip my hat to them. They've been doing great. They have what is a weight loss drug. They're doing great with that. It seems like everything Eli Lilly touches right now is doing great. So their market cap's massive. And Bristol Myers hasn't really been doing much. If we look at the 1 year, look at the 5 year. So there hasn't been any like, wow, hey, Bristol Myers is coming out with this new exciting growth catalyst. Like, hey, they cured this disease, and there's 500 million people with that condition. So there's none of that, which is interesting. So that's one of the things. They have been a very good dividend payer. So if you're looking for a income stock, these healthcare has been held back. In my opening comments, I talked about how the S&P is doing great, but it's left behind a sector or two. The sector that's been left behind is healthcare. If you look at the healthcare space, it has not kept up with the other spaces. But if you look at like a 10-year return or 5-year return, healthcare has always been a top 3 sector. It's no secret why. When these drug companies create a drug and it helps a lot of people, they have intellectual property that protects them from competition, and they make a lot of money on those drugs. So the trick to it is finding pharmaceutical companies that have the right assortment of drugs that are still under patent and they can make lots of money and continue to grow. I'm not sure Bristol Myers fits that category, but let's talk about Pfizer. I'm going to leave this one open and then open up Pfizer. So before I get into comments, I got to say I'm a stockholder of Pfizer, and they have not seen very good conditions for their stock. But has the company been doing well? And the answer is yes. A couple of things. So I just talked about Bristol not having, fun and exciting things happening, but Pfizer's been a different animal altogether. If you look at who stepped up and created a COVID vaccine, Pfizer, and they made a boatload of money. They used to be a $40 billion company, and COVID came around and they more than doubled their business. And they made all of this cash and they put it on the balance sheet. That was great news. But the market said, well, we hate you now because your revenue is dropping. Yeah, because COVID's over. But they're now substantially bigger than they were before COVID. So I'm looking at this data saying, wait a second, this stock should be worth more than it was worth in 2019 because it's $18 billion larger than back in 2019. But if we look at their stock, you'll see that that's not the case. The market, Mr. Market, he's not always very rational. So in 2019, it's a $40 stock. Now it's down and it's a $27 stock. So this company that was selling for $40 a share is now $18 billion larger. Their balance sheet's massive with cash because they made all this cash on COVID. And so I love Pfizer. I love the stock. I'm like, I'll take it. What's the other thing that's exciting? So they took all this cash and said, hey, we want to acquire businesses that have these really interesting, cures to illnesses. And they've acquired multiple businesses. And those businesses are supposed to start generating revenue this year. And next year is going to be even better. So I'm sitting on a good position of Pfizer. I continue to buy shares. Meanwhile, the stock's saying, hey, thanks for buying my stock. I'm going to pay you 6% dividend, 6% dividend, awesome dividend. And again, if I could just get back to the stock price before COVID, $40 a share, I'd be very happy. I think it's going to go beyond that. But this one here is one of those that I'm like looking at it going, at some point, you cannot keep value down. You cannot keep cash flows down. You cannot keep just a good quality pharmaceutical company down. It's going to come up. So between Pfizer and Bristol Myers, I am a Pfizer proponent. I'm a stockholder. I continue to buy shares. The shares are down. I will probably buy some shares today and add to my position. Thank you for the question. Nathan, adding to the GM review, $6 billion stock buyback. Beautiful. I just think the world of their leadership over there. She's doing a great job. And I think GM is in a good place. I think they're going to have a couple good years. So hopefully that all materializes and GM just does great. So Kathy Woods, ARC, latest purchases, NTLA Beam. All right. Let's take a look at one or two of these. So first on Kathy Woods, I don't like saying bad things about people, like negative things about people. But I would say that Kathy Woods is not, I'm not that type of investor. I'm probably I'm a modern version of a value investor, like value investors that are kind of old school, but I've been working in technology for a long time. I really like technology. And so I have kind of a little bit of a lean toward, if it's something that is technology and it's exciting, I latch onto it. So, and the thing about Kathy Woods and some investors like that, some of the super investors that I think could be distracting is she was right about Tesla, I think 3 or 4 years ago. And then she's been wrong about a lot of other things. So it's like, all right, if you're right once, but then you're wrong 20 times, in my book, you're wrong most of the time. So I can't like totally buy into every theory that you have. That's enough on my comments of Kathy Woods. Italia Therapeutics. So I like pharma. I like healthcare. So out of the gate, I'm liking this. This is a company that is Intellia Therapeutics, a genome editing company. So I'm not a scientist, but that sounds pretty exciting. It's a very small cap. They're losing money. Okay, that could be a problem. It's undervalued by 154% according to analysts. Let's take a look at their financials. So they're losing money. Now, I want to look at how much cash they have on their balance sheet, how much cash flow they generate. Because they're burning some cash. Okay. As expected, so when you start a biotech company, you're paying some really top-notch scientists to do work, and that costs a lot of money. So you got to pay them. So you're putting a lot of money into the business. They have $912 million of cash. Hopefully they don't have any debt. They have $96 million of debt. And combined with current debt, I guess they're going to be around $115 million of debt. Okay, good. They have, call it $800 million of cash. And cash flow wise, they're burning $400 million of cash. Okay. So at their current burn rate, they have 2 years before things get really, really tight on cash. So this is an interesting stock for somebody who really understands this industry and can really understand the science and can really understand the end markets. That's not me. I understand cash flow. I understand profitability. And I have enough experience in healthcare and pharma to know kind of an obvious good company. I worked at a pharmaceutical device company. But this here, if you got to really know the science and you got to know that end market's going to be huge, or it's going to be how much more time do they have before they can begin to really get profitable. Those are the things you'd have to get your head around. And that is not an investment that I could take on. All right, so we're going to go one more. We'll go with Beam Therapeutics. So another biotechnology. So in general, I think healthcare has been left behind. I could show you a quick chart that shows healthcare has really been left behind. I think at some point it's going to start moving up. But I'm looking for stocks like I showed Pfizer. I could talk about Catalyst. Catalyst is a profitable growth company. I can talk about UTHR. I'll talk about that one really quick. So this is one of my favorite growth biotech companies. These guys created, some drugs that are really helping people. And the story behind this company is fascinating. The CEO, she was in the communication space. She's helping with satellite communications, and her daughter got sick and had this rare disease. So she shut down her career, studied the science, created a cure, helped her daughter, saved her daughter's life. She took that to market. It's now one of their bigger drugs. And they started a biotech company. And they're now taking on the challenge of growing artificial organs. They grow them in certain conditions, and then for organ transplants. So if somebody needs an organ, they could grow an organ and then that person can get it. It just blows my mind how freaking smart, how advanced these people are. And I love this story where it originated for this company. Study this company. It's pretty darn cool. If anything, it's kind of a feel-good story, and a feel-good story that has some good return. So it's been a good return stock. It makes money and it grows. It's been a growth stock. Now they have drugs that are doing well, selling well, growing well. But if they get this organ transplant thing done, if they get that to market, look out. This will be phenomenal. It'll be like, holy smokes, um, they'll save a lot of lives. They'll give people another 5, 10 years of life, maybe toward the end of their lives, or maybe 20 or 30. I don't know. But I still remember when they first did an open heart surgery and they did a heart transplant. This is like going back 30, 40 years. And they started putting in, hearts to people that were basically going to die if they didn't have intervention. And it seemed like, wow, man, that's really risky. And this is like 30, 40 years ago. And now it's like, oh, open heart surgery, man, no big deal. We do heart transplants all the time. It's like, wow, man, the science has really gotten good. So we'll see how fast this company develops it. But this is one of my favorite healthcare, smaller, but this isn't tiny like the companies we're looking at that Kathy Woods is investing in. This is more my school of investing. Is I worked hard for my money. I don't have to triple my money from this point every year. I just like growing my money by 20%. That'd be great. If I have a bad year here or there, that's all right, because I'm making 20% or more on my investments, and grow from there. So good question. Cinematographers, thanks for checking in, man. Thanks for the question. And it looks like Mike is agreeing that healthcare is down. Yeah, basic material companies I'm interested in. So I'm going to cover TX. So this is one of my favorite basic material companies. And these guys they operate mines. So they mine for iron ore and then take that iron ore and they actually produce steel, and they produce rolled steel. And their end market, so they have a lot of their operations are in Latin America, most of them in northern Mexico. And northern Mexico's economy has been doing well. It's been growing. Mexico's the number one trading partner with the U.S. now. So this company is strategically located in the northern border of Mexico, and they produce a lot of rolled steel that ends up in the United States, or it ends up in production in Mexico for products that end up being sold in the United States. It's the near short story for Mexico. And over the last year, it's down 6%. It's paid an 8.58%, but it really is, when you buy a stock, really determines your rate of return. So I started investing in this company when the investing was good, and I'm sitting on a nice gain, and I get paid a really nice dividend. We just got an inflation report saying, hey, inflation's not a big giant problem anymore. We're probably going to reduce interest rates. The economy is going to probably begin to grow. We see that car companies like GM are doing really well. That's a lot of steel. A lot of steel is going to be consumed. So I'm expecting that although this stock's been kind of flat for a little bit of time, maybe about a year and a half, I'm expecting good things from TX, and that's an example there. BHP is a stock that I like as well. They're down in Australia. They produce iron ore, steel, and so forth. So those are some material companies. They pay good dividends. And the trick to it is you have to buy them at the right time. You see the graph there. It's not a bad time right now to be looking at materials. It's a really good question, because I think if you buy into materials and industrials, like I've been buying into 3M, I wouldn't put them in the basic materials category, but it's not, it's in the same sector. You're buying ahead of the curve for the economy, right? Now that we see inflation, if inflation continues to go down, that's good news, because interest rates will go down, which is good news, which means the economy is going to begin to grow. And industrials, basic material companies, will rise. So not a bad time to be looking in that space for some value, buying it now, and then watching it rise over the next year to 2 years. Thanks for the question. Hearing good things about HIMS. Yeah, I've looked at HIMS. Let's take a look at HIMS. So HIMS has been a growth story, and it's been really impressive how they've done. Let's take a look at the 1 year. And it's about growth, right? So look at this growth here. Phenomenal. And it's a small company. And I'm going to put it in a nutshell. What their business is about is they are basically providing what I'm going to call is generic alternatives to a lot of the mainstream therapies that are out there. So if you have a certain condition and it's being treated by this really popular drug, they have kind of a generic or something, related to that they will prescribe, and they can do that online. It's really been growing fast, and the market cap's 4.8 billion. I haven't gotten into them, and why was I reluctant to do that? So their cash flow is pretty good this year, especially. So I would say that based on that cash flow, yeah, this is an interesting stock. I would say that, a lot of analysts are saying that it's overpriced by 31%. They're probably afraid of this chart here. This chart looks really upward. Obviously, if someone would have bought it here in the May timeframe of 2024, you look like a genius because you're up substantially in 1 month, 75%. So I think it's a pretty impressive company. The thing that I'm concerned about is, HIMSS is one bad story, and it's going to really hurt them. And what's one bad story? They sell a lot of, drugs. And let's say they have a weight loss drug, right? Cheaper than Ozempic. This is their game here. Here's their alternative to buying Ozempic, and I'm not sure which drug this is, but I'm very familiar with Ozempic. Ozempic's really popular for weight loss. Well, some patients take it, and I'm not saying this is happening. I'm not saying this is going to happen. It's just an example. And they get sick, and then boom, lawsuit. Boom. Now it's like, oh no, the things that these guys are putting out there could harm people. That could really hurt the company. And that's what it's my own personal theory of, hey, this space here, you have one bad event and it really hurts you. And if they're providing a lot of alternatives, how much science was behind it. They're a tiny company. We just showed how those other companies that were biotech companies, it takes a long time to get through the clinical trials and the whole FDA thing. Are these guys taking shortcuts? Is it going to someday really end very poorly? I don't know. But right now they're rocking. They're doing really well. Congratulations to anybody who owns a stock. Those are some of the thoughts that I've had as I look at HIMSS. So thanks for the question. Really interesting company, and I'm impressed by how well they're doing. Thoughts on TJX? Is that TJ Maxx? So TJX, yeah. So this is a discount retailer, and these guys were doing really well for a while. They're doing very well. 33% for a retailer is very good. 1.4%. Now, retail, I don't like retail. I got 1,000 companies to choose from. Why would I want to be in a retail business? It just seems like it's such a tough business. You got to hire a bunch of people. You got to rent real estate. You got to, inventory that goes in fashion, out of fashion very quickly. So I don't like the industry, but I know TJ Maxx is a very well-run company. It's a strong buy according to analysts, even though they think that the stock is fairly priced. So they should update their analysis if this doesn't make any sense. Strong buy should be like, oh yeah, it's a strong buy and it's discounted by 30%. Part of the reason is probably because in the last month it's gone up well. Year to date, it's up 15%. So this is a nice stock, but like Target as an example, I think they're struggling. The one company that's did well was Walmart. They're a big, massive, company. It looks like TJX is a decent company. They probably cash flow really well. Retail tends to cash flow well, 4.3 billion in free cash flow. I couldn't get to this valuation, not even close. I'd probably value the company at like 50 billion. I don't like retail, and I would probably put a high risk factor on retail. Not necessarily because TJ Maxx is not a good company. It's just continues to get harder and harder with, online alternatives with Amazon and other companies offering same day deliveries. It's like, geez, man, makes the retail business harder and harder every day. So thanks for the question. Thoughts on Dow and UAL. So yeah, so we talked about car businesses being, undervalued, and not sure why. I'm not sure why my keyboard is locking up here. I have a wireless keyboard and it's going a little crazy. All right, so let's talk about let's talk about United Airlines, because I am a United Airlines stockholder. I can talk about this very easily. So PE ratio of 6.5%, or 6.5, excuse me. Forward PE of 4.9. It's like, what? Is that a misprint? Nope, it's not a misprint. Analysts think, hey, it's really discounted. I agree. Year to date, 30%. Looks good. Well, why do we think that the stock is going to go places? Again, in 2019, here's an airline. It was doing $43 billion of revenue. It was operating as an airline should operate. And then COVID hits, right? And obviously we couldn't travel. People weren't buying tickets and they were just in survival mode. Understandably, it wasn't nothing United did. But now, if we look at compare between 2019 to 2023, the company is $10 billion larger. Good job, United. Very good job. So they repaired their business. They're making money, nice net income. They're making lots of cash. So I'm going to use 2022 as an example. And so they're profitable, their balance sheet's in good shape, but their stock price had been suppressed, but although it's been doing well lately. Now, what's going on with airlines and what's going on with the travel industry? Well, they're experiencing very good times. Like, people are traveling, people are paying up for experiences. Part of it is that for a couple of years, we didn't have the ability to go travel. So we saved up our money. And then once we were able to travel, it's like, you know what? I want to go a little bit further. Maybe never been to Europe. I'm going to Europe. Or, I want to go have an experience down in Miami. Perfect. So a lot of jets are full. So the airlines are selling more tickets and they're charging more when they sell those tickets. So that's easy math. Like, oh, okay, now they're making more money. So United Airlines and American Airlines and Delta, very favorable on. And the one stock that I think is in repair mode is Southwest. Southwest used to be like the leader of the pack. They were number one. And then somewhere along the way, they completely, tripped over themselves. They had a big problem. I think it was the Christmas season of 2023, where they literally had to cancel all flights, return all money to all customers right ahead of Christmas. And the reason for it was they had this old software that just crumbled. It's like, guys, you really let down all your customers at the wrong time. That really the brand took a hit. Southwest, I used to be a huge Southwest customer. And I think a lot of people have lost that, preference toward Southwest. Now I fly whoever gives me the best segment, like direct flight. What's the best hours? I prefer United because I'm a stockholder, but there's no big preference for United any longer. Southwest. So I think airlines are in an interesting spot. How long will the travel boom, persist for? Well, if the economy is going to get better, if inflation's down, interest rates are down, maybe the travel industry is going to enjoy a really good 2025. They're enjoying a great 2024. So we'll see how things go for the airlines. Thanks for the question. Yeah, whatever Kathy Wood says to do the opposite. Interesting, Nathan. I try to be a little a little, I guess, more diplomatic on talking about others because F1 once in a while they're right, and I got to tip my hat to them. What are your thoughts on Berkshire Hathaway? So I think that very good question. I've never owned Berkshire, and I like Mr. Buffett and the late Charlie Munger. Um, I've probably studied them up there with Peter Lynch. I've studied them the most in my life with regards to investing. I think a lot of philosophy or mentality of investing. I can think Warren Buffett. His whole, I mean, he has 100 comments that are like, lock those in, lock them in. That's what you think. That's what you should do. For example, you should have your emotional readiness before you begin to invest, meaning you're going to have downturns. You're going to have, don't get overly happy when stock markets are rallying. Be fearful when everyone's greedy. Be greedy when everyone's fearful. I took that into the real estate meltdown that happened 2007, 2008. I bought 5 investment properties in 2010. I did great. And that's a direct link to Mr. Buffett. So Mr. Buffett's been a just an endless source of knowledge for investors. I don't invest in Berkshire because Berkshire is really a mutual fund, and they've done really well in certain years. But if I'm going to invest in a mutual fund, I might as well put all my money in mutual funds. I'm an individual stock investor. I used to be a mutual fund guy when I was super duper busy with career, family. I didn't have time to analyze companies. But at a certain point, I moved away from professional management of my money because I thought that they were doing an okay job, but I was paying them high fees. So it's like, well, if I'm going to pay you high fees, I want a high performance level, but they couldn't do that. And so I manage my own shares. I have my own way of thinking. I think Mr. Buffett and Mr. Munger have, have had legendary careers, but Mr. Buffett doesn't understand technology. He's in Apple. I get that, but Apple fundamentals are just like obvious. But if you ask Mr. Buffett, let's talk about, the sharing economy, Uber, Airbnb and stuff. He'd probably be completely out of his element. And if you went to another category, cryptocurrencies, they couldn't have that conversation with me. And that's where I abandoned my overlap with Berkshire. So that's my comment on that. And thanks for the question. So another one for you, BLBD. They make school buses. So BLBD. Bluebird. Yeah, I know Bluebird. So Bluebird, they make buses, 1.89 billion. Forward P is 15. Wow, look at that growth. What is going on? Wow. Well, we might be showing up late to the party on this one, but wow, that is really impressive. So why are they selling so many school buses? Are they like going electric, or what's the story? What's behind this? This would be a stock to really dive into and understand, although it might be too late to invest because the stock's really taken off. Geez, just in April, well, it doesn't show it there. From April to this point, the stock's almost doubled. Wow, interesting. And this is going back to their, I think earlier. So they're not an auto manufacturer. I would consider them more like infrastructure because they're doing buses and they get sold to school districts. And something's going on that's really working for the company. Congratulations to whoever owns Bluebird. Wow, what an impressive stock. Sergio, what are your thoughts on Apple? Yeah, so good question. I'm glad you asked. Very nice to see you, Sergio. So I've been in and out of Apple for a long time. And they had their developer conference this week, and they talked about Apple Intelligence and a bunch of other things. to me, it didn't have much. It was just a bunch of stuff. It's like, hey, we have a bunch of stuff. But did it like cut out a new catalyst for the company? And the new catalyst being like Meta tried this and failed, and that's a bad example. Let me try to find one where Microsoft. Okay, Microsoft found a catalyst in OpenAI. They partnered with OpenAI early. They saw that AI is going to be this really interesting thing, and they are really going in that direction and have really used it as a catalyst. Apple didn't go that far. They didn't like show specifics. They've been slow to have an AI strategy. They failed with their Apple Car, which I thought was a really dumb idea to begin with. So all in, I'm like, I'm not going to buy Apple stock. I think it's going to be a stock that just kind of stays at its current valuation, plus or minus 10% for the next year or two. I just don't see any massive innovation, but I do see that Apple does have competition. I was a Samsung user before I went to Apple, and I went to Apple because my wife likes Apple devices. Samsung puts out a great device, and now Alphabet puts out a great device. Globally, there's manufacturers that put out great devices at a third the price of an Apple, if not less. So I think that Apple's going to have a tough time over the next couple of years, and we'll see how it goes. Thanks for the question. All right. Would love to know point of view on PBR. So I think we looked at this one. Yeah. So this is the petroleum company in Brazil. I like oil. I like energy companies. I think they're undervalued right now. This company, you see that it can really go up and really go down. But I'm going to compare it to one of the holdings that I've had for a long time. So my first job out of college was with this company, which was a company that was acquired by Chevron, but it was an oil company. And this stock, it kind of went up and it's kind of been going sideways. And oil, energy is here to stay. When we look at oil prices, oil has been on an upward trend recently. So I think energy's been discounted recently. So in general, I would say this stock here is, I already have Chevron. So I don't buy like, the same type of company, just to have like a set. It takes too much time to analyze a company and stay on top of a company. But if this is the right company for you, where you're comfortable with the Brazilian economy, you're comfortable with this company, I don't see why it wouldn't be a good investment idea, because it's a good time to be buying into energy. It's been discounted, but oil prices are high. This company pays a massive dividend. They can probably afford it. Energy companies produce high free cash. So those are high level comments on PBR. And just saying that, hey, I'm big into Chevron. I continue to believe in the space. This is probably a less risky to an American in the United States. It pays a nice dividend. It's, according to analysts, it's discounted by some. It's discounted according to my analysis. And what I want is steady, and I want this dividend out of an oil company. And these guys are going to deliver potentially more. They're going to give you a lot of volatility, which is good, because if you buy here and then it jumps up to here, awesome. You can do a swing trade. Boom. Buy here, sell here, wait till it goes here. I mean, volatility is not a bad thing if you know when to buy and when to sell. Thanks for the question. Hey, Shadow Guy, back from Greece, man. I hope you had a great time, and hope you had a lot of fun. All right, so any thoughts on CSX? And then I'm going to have to get going. So CSX is the rail company, right? Yeah. So, rail companies tend to be a very consistent business. This one's supposed to be 15% discounted, consistent dividend. I I always find hard to get into a rail company because it just feels like, you know, slow and steady to earn a low dividend. Well, at this rate, I'll just buy some good bonds and I'll be good to go. I bet you they actually issue out a bond and you could probably perform better income, get better income out of that bond, as opposed to this like slow and steady kind of chart. Um, Railroads tend to be like an investment that Warren Buffett loved and other investors like. I always find alternatives that look better than a rail company. And this company, might be a good investment for some. It's going to be a steady investment. They did have a lot of growth with the supply chain issues or a lot of demand out there. But you can see that you have almost a cyclical trend where you have some down years, you have some up years, and then some down years. So that's CSX. Thanks for the question. Yeah. Yeah, no problem. I was referring to CVX on the example with PBR. Yeah, he did. You're absolutely right. Warren Buffett loved railroads. So if you study the investing books that Warren Buffett read, like Benjamin Graham, 100 years ago, railroads were kind of like the internet. They were just, if you owned railroads, it was like almost an assured winner because people had to put stuff on rail. A rail line was pretty much a monopoly to service a particular region of the United States. So they could charge, what they felt was a reasonable price. So it was a really, kind of a good investment 100 years ago. So Warren Buffett read the books of guys that were totally into railroads. Railroads were the internet, the tech companies of 100 years ago. And fast forward, rails continue to be important, but there's alternatives that I like more than railroads. So guys, this was an awesome session. Let me take a peek at where the stock market is at. All right. So we've got the Russell up 2.84%. Nice job, Russell. The Nasdaq's up 1.85%. S&P is up 1.818%. And then the Dow is up 0.47%. Not a bad day. Not a bad day. Hopefully all of you made lots of money on your stocks today. Let's watch this. Watch for the chairman's comments because he could say stuff that really torpedoes these gains. I don't think he's going to. I think he's probably going to be chill and just say, hey, we're going to wait for more data. Probably not say something that upsets markets, and we're going to keep these gains today. And we'll see how stocks trade over the next couple of weeks. Thanks, everybody, for tuning in. Good luck out there. Enjoy your day.